Your home loan is the most expensive debt you will ever carry, not because of the rate, because of the tax. Every dollar of interest on a business loan, an investment loan, a margin loan, the tax office helps you pay. Your mortgage? Nothing. You carry every cent alone. Debt recycling is the process of turning that dead weight into debt the tax office shares with you. Same house, same loan, completely different machine underneath. By the end of this video, you'll understand exactly why one loan earns a tax deduction and an identical loan next to it earns nothing. You'll see the machine that quietly converts one into the other. You'll see the wall you must never cross while you do it, the line the tax office actually polices, and you'll see who this structure suits and who it can hurt. Quick note before we open the plans. This is general information, not personal advice. Your situation is your own, so get advice before you act. Everything here rests on one rule. Get the rule and the whole structure makes sense. In Australia, interest is deductible when you borrow money to produce assessable income. Borrow to buy something that pays you, dividends, rent, business income, and the interest on that loan comes off your taxable income. Borrow to buy something private, the house you live in, the car, the holiday, and the interest is yours alone. The tax office gives you nothing. Here's why that matters in dollars. Say you're in the 37% tax bracket. That's taxable income between $135,000 and $190,000, plus the 2% Medicare levy. On your home loan, $1 of interest costs you $1 full dollar. On an investment loan, that same dollar of interest costs you 39 cents less, because the deduction hands 39 cents back. Same dollar of interest, two completely different prices. Now look at most Australian households. The biggest debt they will ever hold, the mortgage, is the one debt that gets no help at all. They pour 20, 30 years of after-tax income into the least tax-effective loan in the country. Meanwhile, people who structure their money well arrange their borrowing so that as much of it as possible sits on the deductible side of that line. That's not a loophole. It's just knowing which side of the line your debt is standing on. Debt recycling is the process of walking your debt dollar by dollar from the wrong side to the right side. That's the foundation. Now, the load-bearing wall, how the walk actually happens. Here's the move itself. It's almost boringly simple, which is exactly why it works. Start with what you've got. A home loan you're paying down, and over time, some equity. The gap between what the house is worth and what you still owe. Step 1. You split your borrowing. You keep the home loan as it is, and you set up a separate loan, a clean, separate facility, secured against your equity. 2 loans. 2 purposes, never mixed. Hold that thought because it matters more than anything else in this video. Step 2, you draw on that separate loan and you invest it. And here's the only thing that matters about where the money goes. As long as it buys an asset that earns you an income, the interest on the loan becomes deductible. Shares, an investment property, as the type doesn't change the rule. The asset just has to earn assessable income. Because that money was borrowed to produce income, the interest is now working for you, not against you. You've created $1 of debt the tax office helps you carry. One quick flag if property is your root. There are announced changes to the property tax rules that aren't law yet. They'd change how investors use rental losses, as well as how the capital gain is calculated from the 2028 financial year onward. So if you're recycling into property, treat that as a live one and get current advice before you act. Step 3. The investment pays you. Dividends, rent, or capital gain. Income comes in. And at tax time, the deduction on that investment loan could give you a refund, real money back in your pocket. Here's the engine. You take that income and you take the tax refund and you throw all of it at the non-deductible home loan. Not the investment loan, the home loan, the dead debt. Step 4. The home loan shrinks faster than it ever would have, which frees up more equity. So you draw on the investment loan again, invest again, and repeat. Watch what happens over the years. Your total debt barely changes, but its character transforms. The non-deductible mortgage shrinks towards zero. the deductible investment loan grows. You're not borrowing more, you're converting the debt you already have from the expensive kind to the tax-effective kind and building an investment portfolio while you do it. Same total borrowings, a portfolio that didn't exist before, and a mortgage melting away on additional income and tax refunds instead of your salary alone. That's the recycle. Now, the wall. This is where people wreck it, and it's where the tax office actually looks. Remember step 1, 2 loans, never mixed? Here's why. Deductibility follows the use of the borrowed money, not the name on the loan, not the property securing it, the use. So if you take your clean investment loan and redraw $5,000 from it to pay for a holiday, you've just contaminated it. Part of that loan is now private. Your interest deduction gets carved up in proportion, and untangling it is a nightmare. One loan, one purpose. The investment split funds investments and nothing else. Ever. That's the structural wall. There's a second wall, and this one is legal. There's a more aggressive version of this strategy where instead of paying the interest on your investment loan, you let it pile up, you capitalize it, while you funnel every spare dollar at your home loan to kill it even faster. On paper, it supercharges the whole thing. The catch: the High Court has already looked at exactly that arrangement. In a case most advisors know simply as Hart's case, the tax office used the General Anti-Avoidance Rule, Part 4A, against a scheme built around capitalizing that investment interest. Where the dominant purpose of an arrangement is the tax benefit rather than something genuinely commercial, the commissioner can unwind it. So this is the line. Plain debt recycling, borrow to invest, claim the interest, recycle the cash flow, is an ordinary accepted use of the deductibility rules. Bolting on artificial structures to manufacture a bigger deduction is where you walk off the edge. People who do this well aren't being clever at the edges. They're being clean in the middle. The whole point of knowing where the wall is so you can build confidently nowhere near it. That's the wiring. Now, the load this puts on the building. Now, the part the spreadsheets make look too easy because debt recycling has a cost and it isn't on any tax return. Strip away the tax for a second and look at what you've actually done. You've borrowed money to invest in the market. That's leverage. And leverage cuts in both directions. When markets rise, leverage makes your gains bigger. When markets fall, and they do, leverage makes your losses bigger too. The loan doesn't shrink because your portfolio did. You borrowed $100,000. If the investments drop to $70,000, you still owe $100,000. The bank does not share the downside the way the tax office shares the interest. Second load, income isn't guaranteed. The strategy leans on that investment income plus the refunds to feed the home loan. Dividends get cut, tenants leave, companies have bad years. Third, interest rates. We're recording this in June 2026 with Big Four variable rates sitting around 6.5% and the Reserve Bank cash rate at 4.35. Rates move. A deductible loan still has to be serviced, and a rate rise lands on the borrowed money just the same. And the quiet one, the human load. It takes a particular temperament to watch a portfolio you borrowed to build fall 30% in a downturn and not panic sell at the bottom. Plenty of people can run the numbers. Fewer can hold the position when the numbers turn red. The strategy that works on the spreadsheet only works if the person can actually live inside it. None of this makes debt recycling bad. It makes it a structure with real load on it. And like any structure, the question isn't whether it's clever, it's whether the foundation underneath it can carry the weight, which brings us to the last plan on the table, who this is actually built for. So, who is this structure actually drawn for? Not everyone. And that's the honest part most finance content skips. Think about what debt recycling needs to work. Not what you should do, but what the structure itself requires. It needs a marginal tax rate high enough that the deduction is worth something. At 39 cents in the dollar, the tax office is carrying a real share. Down in the lower brackets, the maths is far weaker. The higher your rate, the harder the structure pulls. It needs surplus cash flow, money left over after the bills, reliably to feed the loans and keep the engine turning. It needs time. This is a 10, 15, 20-year machine. Over 12 months, it does almost nothing. It needs stable income because the whole thing assumes you can keep servicing the debt through a rough patch. And it needs a clean loan structure from day one, set up properly because a contaminated loan poisons the deduction. Now, read that list backwards. Someone with no cash buffer, an uncertain income, a short horizon, or no appetite for watching borrowed money swing in value. For that person, this structure is carrying a load it was never designed for. That's the difference between knowing about a strategy and knowing whether it fits. It's the difference between a plan and a plan for you. And it's exactly the conversation a good advisor has before a single loan is split. Which, again, is why this is general information and your situation is your own. So here's the whole plan drawn out. Debt recycling was never a secret rate or a trick the wealthy hide. It's the order of operations. You take the most expensive debt you'll ever own, the one the tax office won't touch, and one clean split at a time, you walk it across the line to the side the tax office helps you carry. You build a portfolio in the gap. You keep the structure clean, nowhere near the anti-avoidance wall, and you only do it if the foundation under you can hold the weight. Same house, same repayments, a completely different machine. That's the breakdown. If this was useful, hit the like button. It genuinely helps the channel reach more Australians who need to see this. Subscribe so you don't miss what's coming and drop a comment below telling me what topic you want me to break down next.